October 2018. A routine bank reconciliation. Someone at Patisserie Valerie, a cake shop chain, 200 stores, listed on the London Stock Exchange, is trying to match the cash in the accounts to the cash in the bank. They don't match. They don't match by a lot. HSBC has flagged something. Something in the accounts doesn't add up. They contact the company. The board calls in KPMG. KPMG starts digging. What they find is not a rounding error. It's not a timing difference. It's not a misallocation between entities. It is a £94 million black hole in a cake shop, not a bank, not a hedge fund, not a complex financial institution with 17 layers of derivative exposure. A cake shop. The finance director is arrested the same day. The stock is suspended. And somewhere in the city, 200 analysts who had been happily buying shares in Patisserie Holdings are doing their own reconciliation between what the accounts said and reality. Patisserie Valerie was not a new business. It was founded in 1926 by a Belgian woman named Madame Valerie in Old Compton Street, Soho. For decades, it was one café, a local institution. Then in 2006, Luke Johnson bought it. Now, Luke Johnson, serial restaurateur, former chairman of Pizza Express, Risk Capital Partners, a man who built a career spotting tired brands and scaling them. He bought Patisserie Valerie for roughly £2 million. Then he started opening stores aggressively. By 2014, it had grown enough to float on AM, the London Stock Exchange's junior market, raising money from institutional investors to fund more expansion. By 2018, there were over 200 stores, nearly 3,000 employees, and the accounts were showing consistent profit growth. Luke Johnson, as executive chairman, was taking home millions in dividends and fees. The city loved it. Analysts had buy ratings on the stock. It was the kind of straightforward growth story that fund managers like to own. Brilliant. Here is where we slow down, because this is the part that matters. If you had opened the Patisserie Holdings annual report any year between 2015 and 2018 and looked past the glossy pictures of croissants, you would have found some numbers worth examining. The first thing you'd notice is the cash. Reported profit was rising nicely, year on year. Operating cash flow, the actual cash the business was generating, was not keeping pace. Now, in a growing business, some lag between profit and cash is normal. You're investing. You've got working capital tied up in expansion. But the gap here was persistent. It was widening, and the explanation in the notes was vague. That's red flag 1. The second thing you'd notice is the receivables. Trade receivables, money owed to the company by customers, were growing faster than revenue. A café chain. Growing receivables. You'd think someone would have asked about that. You'd think that. For a business selling coffee and cake to members of the public, cash transactions mostly. Ballooning receivables are not a sign of healthy trading. They are a sign that someone is booking revenue that doesn't exist. The third thing, and this one is so obvious it's almost insulting, is the cash balance itself. The account showed the company holding tens of millions in cash. The bank statements, as KPMG would eventually discover, had been altered. Chris Marsh, the finance director, had been fabricating bank statements, showing cash deposits that hadn't happened, hiding overdraft facilities that absolutely had. The £94 million gap between the reported position and the real one had been built up, quietly, over years. Now, Grant Thornton were the auditors. They signed off these accounts. Every year. Every year. The FRC, the Financial Reporting Council, the body that's supposed to police this sort of thing, eventually found that Grant Thornton's audits of Patisserie Holdings were not of an acceptable standard. Not of an acceptable standard. That's the regulator's way of saying, how did you miss this? The answer, as far as anyone can tell, is that they largely took management's word for it. They didn't independently verify the bank balances with HSBC directly. They worked from documents provided by the finance director who was fabricating the documents. Brilliant. Luke Johnson has consistently maintained that he knew nothing about the fraud, that it was the work of one individual, the finance director, acting alone. And Chris Marsh was indeed convicted of fraud in 2023. He acted criminally. That is not in dispute. But here is the question that deserves to sit on the table. Luke Johnson was executive chairman, not a passive non-executive. Executive. He was running the business. He was receiving, between dividends and fees, several £1 million a year from this company. He signed off on accounts that, as we've just seen, had visible anomalies available to anyone who looked. The cash conversion ratio, the receivables, these were in the public accounts. They didn't require insider knowledge to see. His defence is, essentially, that he trusted the finance director. That is not a defence that the 3,000 employees who turned up to work in October 2018 and weren't sure if they were getting paid would find especially satisfying. Just saying. Once KPMG found the hole, the options narrowed quickly. Luke Johnson put in £20 million of his own money to try to keep the business alive, which either proves his commitment to the company or, depending on your view, proves that he had something to prove. It wasn't enough. In January 2019, Patisserie Holdings entered administration. About 70 stores were sold to a company called Causeway Capital and continued trading under the Patisserie Valerie name. The rest were closed. Roughly 1,000 jobs went. Investors, many of them small retail investors who'd bought into the AIM growth story, lost everything on their shares. Chris Marsh went to prison. Grant Thornton paid a fine, not a particularly large one, relative to the scale of what they missed. They are still in business, still auditing companies. Of course they are. The FRC has since introduced reforms, which is nice. So, what's the lesson? The lesson isn't don't buy shares in café chains. The lesson is the numbers were available. The cash conversion gap, visible in the annual report. The receivables growth, visible in the annual report. The vague explanations in the notes, visible in the annual report. A forensic eye, or frankly, half an hour with a spreadsheet, would have flagged this business as worth a much closer look. Most people didn't look. Most people bought the croissant story. The whole point of this channel is to look at the numbers, not the narrative, not the press releases, not the chairman's statement with the reassuring photograph. The numbers. Because the numbers, if you know how to read them, usually tell you what's actually going on. Even in a cake shop. Especially in a cake shop. Chris Marsh, convicted of fraud. 9 years in total. The fraud ran. Grant Thornton, fined. Still auditing. Luke Johnson, still investing. Still writing columns. Still running businesses. The 3,000 employees, largely forgotten, as they tend to be. And the £94 million, gone. Anyway, if you want to learn how to spot the next one before it collapses, The 10 balance sheet red flags that were present in this case and others. Links in the description. And if you found a company whose accounts look a bit chunky and you'd like us to examine them, comments are open. Right, who's next?